Okay, so in this video, I'm gonna go over you what is a mortgage. Now, a mortgage is just a loan that you get on a piece of property. So you might think, okay, Lauren, like, yes, obviously everybody knows what a mortgage is, but I'm gonna go into detail in this video on what the specifics of are an actual mortgage legally. So I'm gonna read you this definition from Consumer Finance. A mortgage is an agreement between you and a lender that gives the lender the right to take your property if you fail to repay the money you've borrowed plus interest. So this goes further into, do you really own a home when you have a mortgage on the property? And the answer is yes, you do own the home. Now, the bank that gave you the mortgage has the right to foreclose on that home if you don't pay your payments plus interest, like that definition said. They do have the right to foreclose on you. However, you are still the actual owner of the home. So why are you still the owner of the home in that scenario? You're the owner of the home because the person who owns the home is the owner of the deed of the property. And when you purchase a home, even if you do have a mortgage on it, you are still the owner of the deed in that scenario. So therefore, yes, you do own the home. So principal is what is paid down on your loan every single month. Now, interest is the part that the lender charges. So that's how they're making money off of you as a borrower. They're making money off the interest. So here's what people don't really understand about mortgages. In the beginning, you're paying more interest than principal. As time goes on, you're paying more principal than interest. And that's what an amortization schedule is talking about. Now, I know that's like a big word and that you probably don't know what that means, but that's what it's talking about. Amortization is the schedule that you're paying principal versus interest. So in the beginning, when you purchase a home, you purchased a home for $400,000, right? Now, if you have a fixed mortgage rate, your payments are always going to be the same amount. However, that amount is split specifically by what is going to the bank as interest and what is going to the actual principal, so the actual $400,000 value that you bought the home for. So why is that? Lenders are in the business of lending to make money, right? So all the big banks, they don't have these fancy, nice offices and these huge valuations of companies by lending out all this money and not making enough interest. So how do they get interest fast off of your purchase? That's why in an amortization schedule, you are paying more interest in the beginning than you are paying the principal of your property, which in this case scenario is the $400,000. You're paying more interest in the beginning because the bank wants to make money off you. If you only stay in the house for say 3 years and then you resell the property, the bank wants to be able to make a good amount of money off that loan even though you only lived there for 3 years. They don't want to wait the entire term of the loan, which is 15, 30 years, then when you're getting close to it, make the money off interest because they don't know if you're going to stay there long enough. The average person stays in a home for 5 to 7 years now from when they bought it. So that is completely different than it used to be back in the day. So banks want to start making money now, like when the next mortgage payment is due for you. So that's just a very brief scenario of what a mortgage is and some of the details that coincide with it. And I hope that makes sense to you. If you have any other further questions or want me to do a follow-up video on this topic or any related topics, just let me know in the comments.